Order. Welcome to the Treasury Select Committee on Wednesday, the 15th of October 2025. We're here looking again at artificial intelligence in financial services. This is our third session on this issue, and we're really delighted to have witnesses from the Bank of England and the Financial Conduct Authority to discuss, among other things, how this is going to be regulated. So I'm very pleased to welcome, from my left to right, Jonathan Hall, who's an external member of the Financial Policy Committee at the Bank, Tom Mutton, who is the Director of Central Bank Digital Currency at the Bank of England. So we'll be speaking more for the bank, as Jonathan Hall is obviously an independent external member. We have Jessica Rusu, who's the Chief Data and Information and Intelligence Officer at the Financial Conduct Authority, and David Geale is the Executive Director of Payments and Digital Finance at the FCA. So very warm welcome to you all. We've had some very interesting sessions with financial services and academics and others, and I think really it would be helpful just to gauge from each organisation, so maybe not all four of you, what do you think the greatest challenges are in UK financial services from moving into using AI more? So who wants to take that from the bank first of all? Mr. Mutton?
I can say a couple of things. So first of all, there is a very significant opportunity around artificial intelligence in financial services. I don't think that's going to be a surprise to anyone. And at the minute, the joint survey we do together with the Financial Conduct Authority suggests that by and large it's being used in relatively low materiality workloads. So firms identified that roughly 70% of those workloads are low impact, low materiality. So things like know your customer checks, anti-money laundering, etc. I think provided there's an appropriate regulatory basis, firms understand the artificial intelligence, it would be appropriate to see that start to be used in more material workloads where there may be greater opportunities for productivity, innovation, etc. But there needs to be the right regulation, there needs to be the right understanding around that. So there's a significant opportunity there, but there are clearly some very material risks which we need to be across. The first one of those, evidently, is cyber risks and broader operational resilience. Our survey suggests that some of the models that firms are using are on the more complex end, and that their understanding of management is imperfect at the moment. And I think firms' management have identified that themselves. Only 34% of management feel they have a full grasp of the complexities of the models they're using. Clearly,
that was your survey
jointly with the FCA. John is much more able to talk to this than me because he published a very good speech on it, but clearly herding pro-cyclicality and potential volatility and disruption in critical markets. And then the impacts on systemic institutions, banks, financial market infrastructures, if they're using artificial intelligence in ways which could threaten their safety and soundness, or were it to threaten outages in their services. And all of those are things we're very focused on. And I think there are a couple of points then which sort of draw those risks together. First one clearly is the complexity and opacity of some of these models and the fact they're very dynamic. The second thing is management understanding of those models, including, and I think perhaps in particular, where they're provided by third parties, where they may have imperfect sight into the models. Thirdly, data. These models depend on data, and many of the issues around them originate in the data rather than the model. And then finally, the third-party risks, which I'm sure we'll talk about.
It's interesting when we did our work on outages, we wrote to banks, the top 10 about outages, and third-party risk, even in that area, was clearly a bit of a trend. Mr. Hall, did you want to add anything to that?
I thought that was pretty comprehensive.
Okay,
I'm happy to go into...
Well, we'll get into more detail. Jessica Rusu.
Thank you. So we welcome the opportunity to talk about AI again. The FCA has been proactive in thinking about this new technology, and we speak quite openly with firms and our stakeholders about having an outcomes-based and principles-based regime. And as you know, the UK has taken a vertical approach to regulation of AI, and we have therefore taken time to think about this through the lens of consumers, through the firms that we regulate, and thinking about the overall systemic impact as well. And Tom's already highlighted some of the risks. In terms of the opportunities, we have broadly seen firms in two camps. There are firms that are progressive in adopting technology and thinking about the opportunities that AI presents. and I can talk more about the types of use cases that we've seen. And then we have firms that are more reluctant to lean into the benefits of technology, whether it's AI or other technologies, and have been more back-footed about adopting progressive analytics techniques. Broadly speaking, we see a lot of opportunities, in particular for consumers, such as financial inclusion. We can talk more about use cases, but there are opportunities for the use of machine learning and, in particular, AI to help consumers that are previously excluded from credit type of opportunities to be welcomed into the market. We also, of course, see great opportunities for AML, KYC, and other types of fin crime prevention. Network analytics, in particular, is a great area of exploration. And so there are plenty of use cases and opportunities for firms to think about as they adopt AI. The risks, Tom mentioned a few of them, critical third parties, concentration risks, as well as understanding the interworkings of a model, and we can explore bias in more detail later. But certainly there are data science areas of research and applications and techniques for thinking about bias and how that can be mitigated as a risk through the life cycle of the production of an AI product. So all in all, there are systemic risks as well as idiosyncratic risks for firms.
I mean, and you've both, all your organisations say you're technology agnostic, and you're not prohibiting specific technologies. But there are risks in that, aren't there? That if you're technology agnostic, and does that mean you're not? How can you demonstrate to us that you've got the capability to really understand what extra risks there may be in AI compared with other, or different AI between different AI models? Perhaps I'll start with the FCA again.
So in terms of technology agnostic, this is really important as a principle from not prescriptively stating that there is a certain provider or a certain technique that must be utilized to get to a particular outcome. However, you would have seen in our new strategy published earlier this year that the FCA intends to be increasingly tech positive, and that is very important for good consumer outcomes and good market outcomes as well. And that is something that helps firms adopting KYC, AML, fraud prevention, crime. The benefits of technology are one of the reasons why we're being more assertive about our position on technology, both in terms of the internal ways that we are using technology within the FCA to perform our statutory duties, as well as firms' use of technology.
Do you have the skills that you need to keep ahead of what is a very fast emerging set of technologies?
Well, I mean, Jessica can talk to the skills and training that we have. I think that the piece I would add is that actually, in many cases, what I would see is the risk already exists, and AI perhaps exacerbates that. So if I say, for example, third-party risk, we already see firms reliant on third parties for significant issues. The use of AI within that can make that risk higher, but actually we will already have tools to mitigate the risk and understand the risk. We're also very keen on taking, as we have, an outcome focus. So we have a series of tools. So we have the senior managers regime, which plays to accountability. Again, what we expect the senior managers to do there is to focus on the outcomes and to test the outcomes. That sort of expectation is already there. I think it just heightens that expectation around the use of AI.
So how can you test that? Because one of the points that Mr. Mutton made was about data and imperfect, the imperfections that can get into the system. How can you identify? That's partly what the skills question comes in. How will you be able to go back and interrogate an AI model or algorithms? I mean, you'll have some of this. You'll be doing some of this already, presumably, with the basic algorithms.
So one of the ways that we've been proactive in speaking to firms about how they are using AI is through our innovation sandbox work. So we have two quite unique offerings. One is our supercharged sandbox, and the other one is AI live testing. So the former, the supercharged sandbox, leverages our existing digital sandbox capabilities, and it also provides synthetic data sets. So for example, fraud typologies and other types of data sets that a firm might want to utilize to develop an AI solution. we've also gone further by offering them access to NVIDIA's AI software suite, so that firms have a level playing field and access to the right tools and technology to develop their solutions. Alongside that, live testing is for firms that are further progressed in their own AI solutions and products that they have developed in their firms. And we have opened both of those activities earlier this summer and are ready to begin testing in the next couple of weeks with cohorts of firms going through both experiences. And we think this is the right approach for us to understand both the challenges that firms are taking, as well as how they have addressed the AI life cycle, from the curation of the data to how it's going to be used and on to the implementation. And that gives us line of sight to where the risks are.
That's all great, but could you perhaps put in simple English? So if you were, to explain to the consumer who will end up at the end of the chain of the AI work, when a firm comes in and says, we want to test this with you, can you walk us through what that looks like and what your intervention is at each stage, and what's real sight you get of what is often quite a commercially sensitive model for those firms?
So let me just give you one basic example. So there's a firm that already has a chatbot, a traditional chatbot that you might type into and ask questions. They're looking to move that into a conversational experience so that you can have a conversation and get information that you might need about products and services. And through the testing life cycle, that firm, it would be important for them to implement guardrails around the kinds of questions that chatbot might be able to answer. So if you ask it about a personal situation, it would say, I'm sorry, I'm unable to give you advice on that matter.
Okay, so you would have full sight of that all at each step, and they would not have any problems sharing that information with you?
No, they shouldn't do.
Okay. Mr. Hall.
Yeah, if I could just say, as you said, AI and this technology is moving incredibly fast, and I think actually that is a benefit of being technology agnostic at this stage. And that's because being technology agnostic is kind of forward-looking, flexible, outcomes-based. And so if you think about the new technologies Jessica was talking about, the firms and consumers and other market participants kind of know what is expected of them in an outcomes-based. And as they implement a new technology, they know that those sort of expectations haven't changed. So I think, so that means that, as we're moving through this phase when there's a lot of uncertainty around the technology, then it's really, really valuable. Obviously, what we then need to do is we need to make sure that we're not, technology agnostic is not technology blind. So we need to make sure that financial institutions, from a FPC perspective, are able to withstand, they're resilient to the shocks that they might face. And obviously the question for us then is, are the shocks that they might face changing as a function of AI? And I think we can look at that through the framework of stress testing, for example. So our stress testing framework may start to incorporate kind of AI-based scenarios in a way it might not in the past. So I think at this stage, while there's still uncertainty and while these are kind of hypothetical possible futures, it's really actually valuable. But it's not hard-coded that we need to remain technology agnostic. If there's something specific that means we change that, then we will consider that.
Okay, so if something dangerous emerges, you will perhaps consider how you deal with that.
Yeah, and the big question is there something that's really new, or is this a sort of development of future risk, of current risks?
I mean, when we had the financial institutions and they said, nothing to see here, it's all fine, we'll manage this, what we're sort of getting from, perhaps I'm mischaracterising it, so tell me if I am, from both of your organisations, the bank and the FCA, is that you're monitoring it. You've got the sandbox in your case. You're watching it at the FPC level, so at all levels of the organisation. You're watching it, but are you alert to what might go wrong? And do you know what you're looking for, or are you waiting for something to go wrong before you then act? As particularly for the regulator, I suppose.
So if I take an example, so I wouldn't expect my supervisors to be looking at the individual model. They're not coders. They're not going to go into that. But under interventions such as the consumer duty, firms are expected to design products with a target market in mind, with outcomes in mind, and they should know what to expect. We then expect them to test the outcomes to make sure that those correct outcomes are being delivered and to demonstrate and be able to evidence that. And that we can look at, that we do look at. We look at that regardless of whether the solutions are being delivered through technology or through individual advisors or whatever it may be. So we can at any point go and look at what was it designed for, what's it actually coming out of the other end, and what controls have you got in place around this. So what we can do, even if we don't, aside from the outcomes, we can ask firms what controls they have in place. So examples of good practice could be, we see firms who have dedicated AI risk committees, for example, actually looking and making sure that they've got the appropriate controls around the technology they're deploying. So I think we have that ability to look at the beginning, we have that ability to look at the end, and we have that ability to look at the controls that are in place. And we expect firms to act on it if those outcomes aren't right.
As the models get more sophisticated and learn from themselves, there could be a glitch that occurs between what's intended and the outcome. And how would you have any visibility of that? Again, goes perhaps to the skills point about how you know where to interrogate it. As you say, you can't possibly have enough staff to be expert in a particular AI model or how it develops, because it's just not going to be feasible, is it?
No, and I think there is a difference between what happens in sandbox testing, where firms do get a greater degree of scrutiny, versus day-to-day supervision. But still, we expect the firms to be able to demonstrate the outcome they're expecting that's being delivered. Yeah. We can look at indicators such as customer complaints, we can look at ombudsman experience, we can look at trends in terms of products being sold, particular features and so on. So there's a lot we can ask firms to actually look at to demonstrate whether what they expected to happen is happening. I think there is a point there. You're right. The models get more and more sophisticated. They self-learn. I think that's why we're seeing firms step into this cautiously at the moment, because at the end of the day, somebody is on the hook through the senior managers regime, and somebody is accountable.
The chief executive or chief risk officer, primarily.
Yes, or could be head of business unit. It depends where it is. But somebody has to be accountable for the activities, including the deployment of the technology.
Yes. Can I don't want to sort of put ridiculous hypothetical situations, but clearly the amount of data that is being interrogated and the sophisticated sort of building up of new propositions based on sort of almost compounded use of AI is very, very complicated and can lead to new products being offered to consumers. The chair has talked about the problem of you keeping up with the skills level, but isn't there a real danger that some of these business models are evolving all the time? So the very clear notion that you gave us of, what are you trying to do? What's the outcome? How do you measure it? It's quite difficult to sustain, isn't it, in a world where you've got some of these firms will be using very sophisticated models that started in your sandbox, moved on. How do you account for the sort of frontier actors who are obviously pushing some of the understanding and, actually stay ahead of the game? Because don't you need more specialist skills of people who can actually interrogate what they're doing proactively, rather than just use that rather, dare I say it, sort of older model of looking at how regulation works?
I think principles-based regulation for me is absolutely right in this space, because actually it can move, because the world is moving so fast. If we try and get too prescriptive, then I think that's where we miss things in terms of the framework that's there. So I think this plays right into principles-based regulation across the consumer duty, across the senior managers regime, and across the systems and controls that we expect. We do need to make sure that our own people are able to interrogate what they're seeing. I do agree with that. I think that's different to diving into the model itself and getting into coding. I think it's around actually how does the model plug together and so on. And this may be where Jessica wants to talk about some of the training we're doing to upskill.
I would add a couple of things. Just from a data scientist perspective, we apply the same approach to testing an AI model. So there's no two models that are built with exactly the same parameters. And so you have to, when you're testing a model, look at the data that goes in and the data that comes out. So if, for example, I want to control for bias, if I'm looking at the performance of 10 CEOs and 9 of them are male and 1 of them is female, and I want to predict the performance of a future set of CEOs in a future situation where I have a different gender ratio, there are techniques that I can use as a data scientist to put synthetic data into the training pot so that the future application of the model would be non-biased. But the way you're able to look at the sophistication and the appropriateness of the model is both by looking at inputs and the outputs and measuring whether or not the impact of what is happening measures up against what the firm expects it to use. Now, Tom highlighted earlier that 70% of applications are internal back office. So let's take, for example, complaints handling as a particular use case that a firm might want to automate. That information will be collated in the same way that a traditional MI or Tableau report might be surfaced up to an advisor, where they would review the information and make decisions with a human in that loop, and the ability to interrogate whether or not the information they're presented with is accurate. And that's the same way that we're approaching the implementation of AI across the FCA as well.
What about if there's a rogue bit of data gets in? Would you think you'd pick that up, Mr. Geale, from what you described at that early point? I mean, because that's where it could go quite badly wrong if we're putting our sceptical hats on for a moment. There's a lot of talk about how it's going to solve every problem in the world, but all it takes is one error, isn't it? And then you've got a model that, even with the best will in the world, you won't be able to find that in them. It's like looking for a needle in a haystack.
I genuinely, I don't think we would be able to spot a rogue piece of data ourselves. What we would be looking at is the outcome that's been achieved, and if those outcomes were off base, or there were trends coming in that we weren't expecting, or the firm wasn't expecting, we'd expect them to act on that and go back. Well, firstly to rectify it, secondly to go back to the cause and deal with it. But I think that as these things develop, I think that's absolutely the sort of thing we've got to be alive to. It is a risk.
Anything to add from the banks, Mr. Mutton?
So I think two things I would add to that. So our approach to supervision already is to focus on frameworks, to focus on management accountability. We can't check every position in a trading book. What we can check is the framework which is around it. I think the question is, how do you scale this sort of approach and apply this sort of approach to artificial intelligence? And that's a very active area of work that we're working on, both within the bank and also with industry. We have our artificial intelligence consortium. But what I think is very difficult to do is to say we're going to place all of the emphasis on prevention and detection. I think it has to be about frameworks. I think it has to be about accountability. And then also I think it has to be about dealing with the impact of situations when they occur. I think as David said, it is going to be impossible to get to a sort of zero error approach here. Very much in the space of operational resilience, the way that we approach this is to say there will be events which cause disruption. How do you respond to them? How do you recover from them? How do you minimize that disruption? How do you stay within your impact tolerances? So I think it's about striking that right balance between prevention, detection, and then remediation and dealing with the mitigants. And that's then about having the right frameworks. The second thing, I think, in terms of skills, we know in the bank that the profile of supervisors and regulators has changed in recent years. When I started in the bank and I started in supervision, it was dominated by credit risk, market risk, people with kind of conventional sort of trading experience. Operational risk, knowing about technology, these are increasingly big parts of the skill set, and we've been making that change over a number of years now. And I think actually, if you looked at the profile of who works in our supervision and regulatory areas, I think it's changed quite a lot. I think one of the things we are very focused on, though, is the kind of referee on the pitch type of idea, which is we're not going to train every person to be able to interrogate an AI model. It's just not realistic, nor would it be appropriate. But we do need to make sure we've got enough skills within the organisation to be able to properly scrutinise these, to have a proper conversation about the framework and about the critical modelling choices, the critical data choices. And I think that is something where we're going to need to continue to look at the skills we have available to us. And I think, realistically, every organisation in the world is going to say, even the AI developers themselves are going to say, we need to stay on top of skills.
Well, that's certainly an issue across the piece. There's obviously been a lot of discussion in government, everyone from the Prime Minister down, the Prime Minister talking about the UK moving fast to win the global race on AI, and the government obviously with a secondary objective, particularly with the FCA on growth. Do you think is there pressure on you as regulators to have a light touch approach so that firms can embrace this, given that's a very big drive by government? Do you feel any pressures, Ms. Rusu?
So I would say that at the start of the year, we set out that we would take a balanced approach to regulating AI, and that we weren't going to write any...
In your letter to the Chancellor?
Yes, it was. And we agreed that we would take the approach that I've outlined already in terms of collaboration with firms, understanding the risks and adjusting. And if you reflect upon other jurisdictions that have taken other approaches, you could have written a rule that you would now be reflecting on changing by the time the models are being implemented and adjusted. Things look different. So, for example, high-risk use cases were identified as potentially credit, for example, where you might say there's no way that you would want an AI algorithm to be involved in AI credit decisions. But we've seen many compelling examples where customers are going to have better outcomes through the use of AI in those situations. So that's why I think we're taking a proactive approach in understanding the opportunities as well as the risks in what we've done. And I would just add that in terms of the skill sets across the FCA, we have invested tremendously. Every single colleague has been on training and has had AI education.
You don't see a tension between your primary and secondary objectives, regulation versus and growth?
I would say that we're always quite balanced between financial crime, consumer outcomes and market stability, and each of those aspects reinforces each other. And in terms of our secondary competitiveness objective and innovation focus, we have had so much happening this year. You would know that one of the other hats that I wear is I'm responsible for innovation and innovation services. And I have never seen such an incredible demand for our services as I've seen this year. We've had over 132 firms apply to the Supercharged Sandbox and 50-odd more for AI live testing. We're doing mortgage sprints, so we're looking at synthetic data. So the demand that I'm seeing from firms and from industry for our innovation services is higher than it's ever been.
And there's no tension about your ability to regulate as a result of that? Are you leaning one way because of that and because the government's drive for growth?
No. I mean, I think we're very clear that there are opportunities and risks that come with AI. Also very clear that if people are going to come to us if they see those risks starting to emerge, and we're alive to that. What I would say again, though, is we are seeing, I think, for every risk there's an opportunity that almost comes with it, and it's balancing the two. So things like the ability to give more people advice. I think that can be seen as a positive. It's got to be done safely, and we have to monitor and be alive to those outcomes. But actually, if we can get more people advice, that's a positive for growth, and we would want to encourage that because it matches our objectives and improves people's lives.
From the bank's perspective, you feel pressured? You feel pressured to lean in the innovative direction?
I think from my perspective, government, my behaviour is governed by the mandate, and obviously that hasn't changed. Within that mandate, there is this kind of balance between, with the primary and secondary mandate, there's the balance between efficiency and resilience. And I think here, the easy way to say it is, safe adoption, safe innovation, and those two capture both. So hopefully that's, for example, when we were talking before about the risks, then, you can adopt technology pretty fast if the risks are low. Back office type things, as some kind of assistant. And if there's high materiality, then it should be the case, and it is the case even with the firms themselves, that they would adopt that technology more carefully, more slowly, with more testing. And so I think balancing like the gains and the potential risk, is not at tension, and not in tension with our mandate.
Okay. Well, I just wanted, before we move on, touch on regulators established, but ultimately Parliament and government sets the rules. Parliament passes the legislation. Ms. Rusu, you've been quite emphatic about you've seen our policy-making process, as you said in a speech to the FCA about the FCA's strategic priorities in July of this year. You've seen our policy-making processes. How could we possibly write rules that keep up with the speed that AI is changing? Which is a fair point, I think. But you, Mr. Hall, the FPC has the ability to, you can make formal recommendations to the Treasury for legislative change. Do you think, from what Ms. Rusu is saying, she thinks probably not, but do you think that the FPC is likely to recommend new powers for the bank to regulate AI?
Yeah, I think the FPC, we're looking for systemic risk, and that could come through one of kind of three main areas. One is through the systemic institutions. So, for example, are they building up significant risk in terms of their capital allocation that will put them at risk and therefore risk the services they're providing to households and businesses? So that would be one potential systemic risk. Another one, which I wrote about more in my speech, is sort of systemic markets. For example, the gilt market. If we thought that was particularly at risk due to, for example, herding or increased interlinkages as a function of AI. And then the third is systemic services like payment services, and there your risk is often linked to either third-party providers and operational risks or cyber attacks. And so if any of these risks build to the extent that we think they're systemic, then obviously the first line of defense is the firms themselves and the micro-regulators, but then we would potentially act in terms of a recommendation. So at the moment, all of these things are kind of hypothetical future worlds. We're watching them. I think our job at the moment is to monitor, firstly in terms of, are things growing, are the risks growing as we think they might do? But also, are we wrong? Is there a new risk we haven't thought about? Is there something that's, turning out differently to how we expected? And then we will respond. But I think, obviously, it's too early at the moment. We do not think there's a systemic risk from AI technology that's already been adopted at the moment. So, of course, we haven't made any recommendations yet.
Ms. Rusu, you do make a fair point that our legislative processes move slowly and once in primary legislation take a very long time to change. But there may well be a need. So is there anything you wanted to add to what you said in July?
I spent many years of my career in risk and risk management roles, and I think it's always very important to take a proactive approach, which is the one that we have taken, which is assertive in speaking to firms about both the opportunities and the risks, understanding and going on the journey together. And I think through the collaboration we've been doing domestically and internationally and with other stakeholders, I think that is our best opportunity to mitigate the risks that we face.
You don't see any need at all, can't foresee any need for some limits around this set by government and Parliament?
I wouldn't forecast that we'll never reach a place where we don't require additional regulation. I would say that the approach that we've taken thus far, in the 4 years that I've been at the FCA, AI has gone from a topic that no one wanted to hear me talk about when I wanted to talk about it.
Now everyone's talking about it.
To the one that I get asked about every day. And so therefore, trying to look ahead and think about all of the things that we might need to be on top of, whether it's quantum or whatever is the next technology, I think we need to be proactive.
Okay, well, thank you. We've got a lot of other ground to cover, and I'm going to ask John Grady, MP.
Yeah, thank you very much, Dame Meg. So just starting off from first principles, the problem here, it's all very exciting, but the way the problem's been described by Professor Sandra Wachter at the Professor of Technology and Regulation at the University of Oxford is that she says not even those who built the system fully knows what goes on inside the black box. Would you agree with that basic premise? There's a quick yes-no along the table, perhaps working from Mr. Hall along to Mr. Geale.
Can I not give a one-word answer? So I think
words maybe.
So there's a real question here, which is what do we mean by understand? So on the one hand, no one understands in fully what is going on inside those models. So we had this answer, like 46% of people say they have partial understanding. So how can they be implementing that technology? Well, their understanding is great enough for them to implement the technology. And so I think and how do you sort of bring those two together? By the risks. So if it's a material risk, your level of understanding has to be almost full. If it's a relatively small risk, then it has to be. And so that's how we can sort of merge that. But of course, no one is going to be able to fully understand. And so then the question is, how do you bound the model? How do you test the model? How do you check for surprises? How do you look at the model versus a simplified version of itself? How do you interpret it with features? And do you have a kill switch? All of these things can mitigate.
Just on the risks piece, is that what you're getting at there, is the risks of deployment? So if it's a low-risk deployment, you don't need to understand as much, whereas, if you're betting the bank's balance sheet on something, then you jolly well do need to understand. Is that what
Absolutely. You're getting at? Yeah, so a research assistant, AI as a research assistant is much less risky than AI as a trading agent, for example.
Mr. Mutton, do you have anything to add?
So I think it depends what the model is and how it's used. I think the key thing is understanding of when it's changed, and I think that is one of the most difficult pieces in here.
And how would you recommend we go about controlling for when the model's changed?
So I think there's clearly quite a significant volume of work at the moment, particularly in the AI industry, around life cycles and documenting and tracing life cycles of AI models, understanding the parameters under which they work, understanding how they've been trained, understanding the circumstances in which they were intended to be deployed. And I think that concept of life cycles, of traceability, and of having transparency and communication through things like systems cards about how those models operate and when they will change is really important. And then I think there are growing kind of bodies of techniques which can explain the model's performance. Those techniques on their own may not be adequate to fully understand it, but they take you a good way towards understanding how the model works. And I think those things taken together can give a degree of comfort, but there will still need, in certain critical applications, to be further safeguards like kill switches or other things.
I think what I take from what you said there, Mr. Mutton, is that there's work ongoing to understand these issues. It necessarily follows that that work isn't complete. Are you worried that things are being deployed with insufficient understanding at present in the industry?
I think it's the nature of science and innovation that things will change all the time, and that's often desirable. So nobody is going to have perfect understanding all the time. That would be probably not a good outcome. I think what we see from the financial services industry is actually quite a high level of caution and prudence around how they're using it. The key thing for us to understand is whether it starts to move into more critical markets, more material deployments without the commensurate increase in understanding and safeguards. And that's a thing where we're engaging very actively with financial services institutions, but also speaking to academics, to technology vendors to understand that. And I think that will be a real focus of the work we do in the coming years.
How are you going about understanding that? Just talk me through in simple terms.
So I think there's three things in particular. The first one is we supervise a set of systemic financial institutions. That means we can have frequent contact with them and talk to them about what they're doing. We can also use things like our survey, which gives us quite detailed insights. And we talk to technology vendors, so we have that sort of market intelligence. Secondly, we have our bodies like our Artificial Intelligence Consortium, jointly with the Financial Conduct Authority, which is actually us working with sort of leading figures to really understand what is going on and understand what we need to know about it. And then I think the third thing is increasingly using artificial intelligence ourselves gives us that applied knowledge.
Are you content, obviously you've put a bit of work into understanding it, but are you content that all the institutions that you regulate have people who have got sufficient understanding of this, given what you said about people working on understanding as they implement it?
So I don't think we can ever say with certainty that every institution understands what's going on. And in fact, the institutions themselves have said, I think it's 34% of them said, they don't have a full understanding of what's going on in these models. To some extent, that's always going to be the case when there are third-party models. So no, we're never going to be able to say that everybody has full understanding. I think the key things are to make sure that there are very clear expectations, there's clear accountability, and that there's alignment of incentives. And I think at the moment, actually, the incentives are aligned. We want people to innovate, but do so responsibly. And I think businesses are very aware of the risks which come from flawed deployments of artificial intelligence for their reputation and ultimately for their P&L.
And they can be aware of those risks, but help me out a little bit. Do you think businesses themselves actually understand this to a sufficient degree? When you come across, the financial services industry, you have discussions with them. Are you confident that people you're talking to have got the requisite level of understanding of AI, pros and cons, risks and rewards?
Right now,
it's quite subjective, but that's what.
So right now, what is quite clear is financial institutions have access to some highly accomplished people who are working on this because there is a big opportunity around artificial intelligence. We're not going to be able to say with confidence that they're always going to have the people they need. But right now, I think when you take that the workloads are on the less material end, and the fact that there are very authoritative people in institutions, I think there is reasons to feel that this is something they can stay on top of, but we're never going to be able to say with confidence that at all times they understand everything that's going on in these.
Maybe a question for the FCA, Mr. Rusu or Mr. Geale. How about the management structures around this to make sure that senior management properly understand the risks? Are you minded to change what you require? Have a new senior management function dedicated to AI or something like that?
So I think firstly, I didn't understand it isn't a defence, because you should understand what you're deploying, or you should understand what you're seeking to achieve. As I go back to the points about designing products and services to meet a need, having clear outcomes in mind and being able to measure and demonstrate those. I'm not sure that needs a new senior manager function. I think it would be captured under the framework that's already there. I would also say that, going back to your original question around what happens in the black box if it evolves and people don't know what to expect coming out of it, we have taken action on that before. Not necessarily around AI, but around algorithms being used in the high-cost short-term credit market, for example. We've taken enforcement action where the firm did not adequately understand what was happening in the black box, and the outcomes that were coming out were not sufficient. So we can and have taken action in those sort of circumstances before, with a combination of the senior managers regime, consumer duty, systems and controls rules, and indeed our threshold conditions for firms. I think we've got the tools.
Have you, in respect of that's algorithms, moving on to AI, are any of you aware of kind of action being taken where you've intervened with a firm and said, look, you don't have the right management structures in place, or, you know, we've had these discussions with you, you're clearly not across the detail of how this works and this carries too much risk?
Specific to AI, no. I'm not aware of any specific conversations on that front, beyond the fact that we do have conversations with the larger firms. We would seek to interrogate before they go ahead that if they're talking to us about the AI applications they're considering, we'd seek to understand that they've got the controls in place. And I would refer back to Tom's earlier point. What we're seeing is firms adopt this in a cautious manner, I think because of the responsibility and accountability that goes with the senior managers regime. So the buck stops with an individual.
Are you confident that the people you're coming across in the industry fully understand the risks of this?
I think I would say the same as Tom, which is, but probably on a wider scale, which is we regulate around 50,000 firms across all sectors, and therefore I can never take confidence that everybody fully understands it. What I would say is the approaches we're seeing at the moment are cautious.
One of the big things people ask about is, and this question really for Mr. Geale and Ms. Rusu, is transparency and explainability in decisions, which is an aspect of a consumer duty. How would you go about assessing whether a firm's AI decision-making had sufficient transparency and explainability?
I think it would depend on what the use case was. So, for example, I myself have worked in previous jobs in credit decisioning where you can employ an AI model as you would any other statistical model to make a decision. And you would need to understand and record what were the variables that were most predictive of that decision. And then you would need to look at your pricing framework and your decision-based outcome to make sure that you're confident that you're offering whatever the model is, whether it's a traditional statistical model or any other AI model, that you understand that the decisions that you're making are in line with your expectations around consumer behavior. And I would say just in general, we have a broad suite of supervisory tools available to us, not just looking inside black boxes. We monitor complaints, we monitor social media, we monitor the sub-hub. We have multiple sources of intelligence that let us know if something is happening within a particular firm that's not okay.
Two follow-up questions. First of all, you mentioned a vast amount of demand for your sandboxes. And they're pouring through your door. And it's in a way consistent with the chat we see more generally about huge sums being invested in AI. Can the FCA keep up with this?
So I think we are, and we have. We've doubled our throughput, in particular for these cohorts, because of the size of the demand. In the past 4 years, I've doubled the size of my team, and we are looking across the entirety of the FCA with a lot of enthusiasm in AI. So everyone is working on it, not just my division.
Would you have an emergency switch you could pull if you couldn't keep up with it? just because of the volume of demand. You've got your day-to-day regulation regulating existing applications.
So maybe I should say differently. We don't expect or require that every firm needs to go through the sandbox. It's not a requirement, it's an opportunity.
Mr. Dean.
Yeah, can I just come in on that point? Because I remember speaking with fintech people before, and they were saying their experience a few years ago was that getting access to the sandbox was easier, and I guess that's probably partly related to the increase in demand. I know it's an opportunity and it's not a requirement, but obviously firms will feel much safer entering the marketplace having gone through that process because they've got the reassurance required. And so, given that the government wants you to also be growth focused, and this could act as a possible constraint on growth because firms might not want to enter the market until they get a chance to do this. Do you think that you need to be resourced better by government to be able to open up this opportunity?
What I would say that we do on the outside of any sprint that we've done is we publish the results. And so we are intending to have showcase events where we play back to the industry what was tested, what was the outcome, how did it work, and that gives an opportunity for others to look at those use cases. So let's say, for example, there was a really successful pilot of a consumer conversational chatbot. That would be published, and everyone would have the opportunity to look at that and think about that and whether or not it applied to their firm. So as I said, it's an opportunity to go through the sandbox, and in fact, we're cautious about accepting only the firms that we think have genuine positive impacts on the market and genuine use cases that are worthwhile testing.
That's all great, and the collective learning bit in particular. I guess my question is, though, if you have more resource, would more people go through it? Would we be seeing more firms entering the market with confidence?
Not necessarily. I've kept the acceptance rates at 30%, pretty flat over the past 4 years, independent of this latest growth in AI. And that is purely because the application needs to be of high quality, important impact for the market, do something for financial crime, consumers, market outcomes. And those are the reasons why we keep our cohorts small, and also so that the impact of them can be more successful.
Thank you.
Mr. Coughlin, just briefly, please.
Thank you, Chair. For my sins, in 2007, I was a Deloitte auditor in New York, auditing collateralized debt obligation models for a major investment bank to a 1 year before it all collapsed. I can assure you that I didn't have a clue what was in those models. I'm pretty sure nobody in the bank did, except possibly the maths PhDs who built them. And with respect, the attitude back then, I'm sure it's different now, to regulators was one of contempt that, regulators aren't paid enough to understand what we're doing. Anyway, the market is always right. So just hearing what you're saying now, I have a slight sense of deja vu around that. And of course, I understand we need to have growth, vital. How do you balance those risks that the same thing doesn't occur again? It sounds quite familiar, and obviously the issue in 2008 was that no one knew where the debt was or who owned it. So I guess all the counterparty risk, that's, I guess, is maybe part of the answer. But I guess Mr. Hall would like
Yeah, so I was in the financial markets at that time. To me, one of the biggest issues at that time was that in order, when you built up these sort of securitized, collateralized debt obligations, the packaging basically was trying to get the benefit of diversification. And how do you get, in order to get, high rating, and how do you get that? Well, you get that by having a sort of low correlation between the different sort of, for example, mortgages in the securitized product. And so, maybe they're different kind of parts of the US, they're different, ages. And so you have this sort of correlation which gives you the diversification, which gives it a good rating. What was interesting about that is that correlation is something that obviously is subject to change. So basically the system as a whole had huge risk to this correlation assumption. And that correlation assumption might have been wrong, that's one point, but the more important point is that correlation could change significantly. And what happened is that correlation went from very low to very, very high, as basically everyone in the US got into the same problem at the same time. And so those that lost a lot of money at that time were the ones who not only kind of had mispriced the correlation, but actually didn't realize their sensitivity to that parameter. And so I think that's why it's a really good question, because if you think about the kind of interpretability or chat values or whatever, trying to work out how your model works, you're getting these features out. But at that time, what you had is this one feature which some institutions really weren't focused on, and that was a huge risk, and they didn't understand their sensitivity to that. And so I think so when we think about these models kind of being dynamic, evolving, having kind of parameters that many times are kind of relatively low importance, but in a different market environment might be high importance. How do we ensure that people understand that they have this sort of sensitivity to this risk if the paradigm shifts? And so I think it's a really good question. I mean, it's really hard, obviously. And I think, for example, one thing you can do in AI models is you can actually think about new kinds of stress testing. So you have adversarial tests, so you actually try and use kind of AI techniques to find out where the model might not work and target that. And so that's a new thing that the market hasn't had to do in the past. But what we need to do is find sensitivity to parameters, which some firms failed to do that then. And I think it's a big risk at the moment. Obviously, the size, the exposure to those parameters at the moment is tiny. Yeah. As risks build up, the size of exposure to those parameters will build, and it becomes more and more important for us to be able to locate that.
Thank you. Well, this feeds in some further questions I think we'll have later. John Glenn, MP.
Yeah, could I just build on something Mr. Grady was talking about around the consumer duty and the FCA's expectations of how that requires what it requires firms to do? Can I just clarify in terms of the transparency and explicability of their decisions of consumer outcomes? There's been no enforcement actions against firms on the basis of not meeting expectations. Is that correct?
So I'm not aware of any enforcement actions that have concluded. Certainly we have worked with firms, and it's very easy to look at enforcement as the only thing we do. We do a lot through the supervisory lens. So if you look at, for example, the work we did around savings, where we actually went to firms and said they weren't being clear enough with people about the options that were available to them. We've seen some quite significant behavioural change there. I can't recall the figures, but they're significant in terms of actually people moving from instant access into notice accounts where they didn't actually need to be in instant access, and actually closing the gap in terms of movement between base rates changing and the rates on deposit accounts changing, as well as the disparities between different types of instant access accounts. So that's in the transparency space where we've seen firms not doing enough to explain to consumers what the options are. We didn't need to enforce. We achieved the action we wanted, the outcomes we wanted by using supervisory tools.
I think that's very important for people to understand, because often this is asked as a measure of whether you've done anything. But of course, you're having a dialogue all the time to nudge people into the right place. Is that the right way of looking at it?
I think it's exactly it. I mean, whether nudge may even be a bit weak in some cases in terms of certainly the first thing we would do is actually seek to is identify the problem to firms and say, seek for them to do something about it. If we saw that there significant harm had been was in place, we'd expect them to remediate. In other cases, we expect them to fix forward.
Thank you. I just turned to Mr. Rusu about the issue that you were beginning to talk about around your prior experience around credit, and perhaps we could broaden this to insurance as well. If you're a firm, you obviously want to make a profit. If you want to make a profit, you want to identify clients that you can make a profit from. But similarly, you want to probably exclude a long tail of consumers that may not be profitable to you. That's sort of rational economic behaviour.
Yes.
The concern is, and I think some of the evidence we've received shows that AI can build up and infer attributes at a level that probably goes beyond your experience, even if it was quite recently, because you've said it's all moved very quickly. How is the FCA properly evaluating the risks of consumers being essentially targeted by the assumptions that can be laden within AI, and therefore being excluded from access to products?
Yeah, it's a really good question. So as data sets have expanded more and more over the years, also looking at open finance data, and possibly there are some firms that might web scrape data and use all sorts of information to have a more compelling offer. I mean, there's two things that happen. One, which is that actually consumers get better rates or better prices that are more accurate. So generally speaking, the more information a firm has about an individual, the better and more surgical they can be about the offering that they make. However, there is a positive opportunity as well. So, for example, consumers that have historically characteristics that might associate them with not having access to credit. For example, living in a particular postcode that has a high crime rate, for example, can actually demonstrate through other information that is made available that they have a well-paying job, that they have other good behaviors that make them a valuable opportunity for a firm to lend to them. So yes, it is a risk that some firms could, or some individuals could be excluded from credit or other such insurance opportunities by having more and more information. But logically, it tends to, to the conclusion that the more information a firm has, the better they will be at offering credit or insurance.
On the flip side of that then, I understand exactly what you're saying, is that you can have more data, so you can be more informed and therefore avoid some of the biases that come from glib, sort of easy assumptions about postcodes. Yeah. But how do you avoid a situation where firms don't go down that route and don't use the best of what's available in order to maintain minimal access to generally problematic postcodes?
So that could be the status quo today. Could be that firms that haven't leaned into data science or technology in general, notwithstanding AI, there are firms that are more advanced than others in terms of how they're using data science. And so where we're able to identify that is through the information that we gather through your previous questions on consumer duty. We look at outcomes-based metrics. We're able to see what the outcomes are for vulnerable consumers and other consumer groups. And we do a lot of other listening to consumers, and we have supervisory intelligence that helps us identify where those things are happening.
So can I just dig in a bit further into that? Because I think Nikhil Rathi, your CEO, spoke last year about the issues around hyper-personalisation, tailoring products. How will the consumer, and how can we as a committee and others transparently evaluate your sort of scrutiny of what's happening in this space? Because it's sort of like proving something that it's sort of counterfactual almost in terms of what's moving in postcodes or ethnic minority groups or a range of perhaps vulnerable groups. Do you actually publish any data that is meaningful in this regard that we can say, things have moved forward in the right direction or the wrong direction? Is there anything you can point us to that would be helpful to see how this works?
We did publish a research note actually recently, I think it was last year, on insurance, where we didn't find any evidence of systemic bias. So we would expect, for example, areas such as younger drivers are higher risk than sort of perhaps some older drivers. And even then, I'm not sure it's a one-for-one. You can use telematics to actually help and interrogate that through AI models. Yep. But we will be doing further work in the insurance area, looking at the interaction of AI with firms' pricing models.
Can you be as specific as you can on when and what that will be, Mr. Geale?
It's likely to be next year. We're considering as part of our programme of work on insurance for 2026. We'll be setting out our priorities probably around February for the insurance sector. I expect this to be amongst them. And what we'll be doing is picking up with a series of firms to actually go in and ask them exactly how they go about that.
And I would just add that the analytics team have done several pieces on bias research, and the mortgage bias research article was published a couple of weeks ago.
Thanks. Ms. Dean. Yes.
Yeah, just a supplementary on this one, and it might be out of bounds for you guys as regulators, because it's possibly more a question for us, but do you ever think about whether there are ethical boundaries to what's going on as well, or push things back to the government so you might need to think about this? Because there's also the ability to track more than we've ever tracked before in the insurance industry, and I've used the example in this committee before of not keeping up with your step count and your life insurance premium goes up the next month, for example. That's possible at the moment, and it's probably legal at the moment. Do we want that to happen? I'm not sure. So are you finding that as you're wading your way through this new technology, there are ethical questions that need to be bounced back towards us, and how does that process work?
There certainly will be. I would say what we would expect is firms where customers take out any form of insurance, if it's linked to things like a step count, then they need to be explaining that to people on the way in, not halfway through. So people need to be clear what they're actually purchasing and the terms on which they're purchasing. So you can, for example, buy insurance that does give you a benefit for having such arrangements, like keeping up a step count. You can equally buy insurance that doesn't take that into account. So there are different things that I would say firms should do on the way in to make clear to people what they're getting. There may be points, I think it's a fair comment that there may be points where the data gets so strong that actually certain communities may be at risk of being excluded. That I think is a social policy question. We cannot force insurers to insure, for example. We can't force lenders to lend in particular areas. So there may be some social policy questions that come up. I think the key thing is for us to keep on top of the research and the monitoring.
I guess my question was more about the process for that, because you're at the front of this. And you're probably more likely to spot ethical dilemmas that perhaps are more philosophical. I know we have got a philosopher on the panel somewhere, I think, but are probably more relevant for us to answer. I mean, when you spot those, do you pass them back to them and go, we've been confronted with this at the moment, that's all legal, that's down to the market, but we think you should think about that. Is there any process for you feeding back those kind of things?
So we have a regular dialogue with different parts of government, including the Treasury as our sponsoring department. We also have a perimeter report, so if we find that there are risks emerging that are outside of our remit that we feel worthy of being raised, we will raise them.
Thank you. We have the insurance companies in, so I think there's some further work for us to do in that area for sure. Mr. Grady.
Yeah, just perhaps a question for Mr. Hall and Mr. Mutton on AI-driven trading, in particular autonomous AI market trading. Is it being used? Is it a concern? And at what point would you intervene in regulating it?
So I think if we talk about kind of quantitative and high frequency market making, that probably is going to be one of the areas where we sort of see cutting edge technology implemented fastest, and I think kind of it's happening right now. It's very early days. So I think the way I think about it is sort of two risks, and the first risk is that actually it goes really, really well, and it's incredibly successful. And we talked before about the financial crisis, but this would be more like a LTCM kind of 98 scenario, where you have these sort of super intelligent traders who actually have a really good model. They know where fair value is, and they're incredibly successful. And so then if that happens, you will find kind of market share going more and more to these models. You'll see a very fast transition, so that sort of most people are using these models, and those that aren't using them will kind of stop trading and stop making money. And so there'll be this effect where the market becomes more and more efficient, but there's more and more dominance of this one kind of model. And the issue with that is that this sort of efficiency eventually comes with a brittleness. And so then you can have some kind of shock, some shift in paradigm. Obviously in LTCM it was kind of the Asian crisis, and then Russia defaulting. That led to, their model didn't become wrong. It's just that their risk was far too great, and a divergence away from fair value meant that they all blew up spectacularly. And another example of that would be, just as you see in the market, sort of short-term basis, would be flash crashes, where everything's going well, then something comes in from left field, and they all get out at the same time. You see a very sudden. Now, that's not systemic, but if you imagine that at a much larger scale. So that's one risk. Now, how could we monitor that? Well, that's really about kind of concentration in the market. It's about kind of diversity of the financial ecosystem. And so that's something that's quite hard for us to monitor, but it's something we really have to monitor. And then the other risk, which is much more like we discussed before, is that these firms start to implement something which looks like it's good, but it has some flaw. And then you have a shift in paradigm, and then that flaw is emerged. Now that's, I think, where interrogating the model, looking at kind of the underlying kind of parameters of that model, having kind of off switches, etc. That can sort of protect you in that. So that's more of a kind of model and a responsibility on the managers of those models, whereas the other one is more on the kind of financial ecosystem as a whole, which I think is a little bit harder, but we actually absolutely have to monitor.
Have you done any contingency planning for an AI-driven market crash at all? Is that something that you've looked at?
I don't know if we want to talk about a stress test, but we have done a system-wide stress test. It wasn't on AI, but I think that kind of stress test is something that in the future we could definitely apply a kind of AI-driven scenario to that. It was the first one we did. It's exploratory. It uses the market as a whole, and I think that's definitely an area where, as these risks evolve and we're able to sort of really think of a scenario, that we could apply that, and that would, I think that could be pretty valuable.
Thank you.
Thank you very much. Bobby, Mr. Coughlin, did you want to come in briefly on this?
Following up on that, thank you. I mean, I guess from what I'm hearing is kind of like we're doomed anyway, right? As in, there's not a lot you can do about this. I mean, you can do these minor risks, but efficient markets mean it's going to happen anyway. So I guess as long as credit markets aren't being frozen like happened in 2008, I mean, a crash is a good thing over the long run. That's capitalism, right? Or am I wrong?
He's not going to say that.
No, I think we're straying a bit here.
Yeah, so obviously what we aim to do at the FPC is sort of build resilience. And so, for example, if you look at our kind of recent reports, there's a lot of global on a kind of markets level, there's a lot of, risks out there. And then you look at the actual UK economy, you look at UK households, you look at UK corporates, you look at UK banks, they're actually pretty resilient. And so I guess, in that instance, you can have a shock, but it isn't sort of disastrous like it was in 2007, 2008. So I think that is, but I guess when I'm talking about these scenarios, to some extent, it's a kind of thought experiment, it's what might happen, but that informs, what we're looking at, what we're worried about, the way we're thinking about future regulations. So hopefully by coming up with these scenarios, we're able to sort of plan and be a little bit more front-footed than if we were just kind of saying, I don't know, this is complicated.
Thank you very much. Bobby Dean MP.
Thank you. I want to move on to the third-party dependency element of this. And statistic in front of me here, 90% of UK banks rely on AI from Google, Microsoft and Amazon. I find that slightly terrifying. They're all US tech companies. Just imagine if we had a US president who's willing to throw his economic power around, it would be problematic. I know that the banks kind of already highlighted this as a key risk, right, to UK financial services. I mean, how big of a worry should this be? And not just, we heard from other firms that it's not so much a worry. We're used to dealing with third-party dependencies. We've got a way of managing it. But given the political activity of the US president over the last year, is there additional risks to the UK being so heavily reliant on US tech companies?
So I think something I can say on that is it's quite right, the attention on critical third parties. It doesn't really matter where they're geographically located. It's their importance to the UK economy and UK financial stability. So the key thing is how important are they, not where are they geographically located. And this isn't exclusively about artificial intelligence. This conversation started with cloud computing. And actually one thing that we've tried to emphasise in a lot of our work is it's actually quite hard to unbundle this, that you can't really unbundle the AI model from the cloud provision, from the data provision. So you have to look at it as a technology stack. And actually, frankly, they tend to come as a package. So that emphasises and underscores the importance of these third-party dependencies. We've paid really close attention to this since 2017. As I said, that started with cloud. In 2021, the FPC made a conclusion that this was a material issue for UK financial stability. We asked for a critical third parties regime. We got it, and it's something that we, together with the FCA, can use. That's been in place since 24.
Before you go, can I just clarify, is that just on the cloud element or all the element?
So it will be on any critical third party.
Fine.
And ultimately, that's a HM Treasury decision around designating those. We can provide information, but it's Treasury that make the decision.
When you say Treasury make the decision, is that just as a normal Treasury decision, or do they have to past legislation or guidance? Or
so it's a Treasury decision. They've published their approach, so that's
so
a massive.
It's just a publication at the moment.
As I said, we asked for that regime. We got it. It's something important, and I think we intend to make use of it. But we do need to work through to what it may want to be applied and how we will use it in practice. And that's some very important work. And I think that is a very important way of speaking to this issue of third-party dependencies, which are really critical. But going back to your original question, I think it's less about the geography. It's more about how critical is it to UK financial stability and the UK economy.
Yeah, I respect, and I guess you're saying it's very critical. And I respect why you're making that distinction. But I guess the reason why I highlight it is not particularly because I've got concerns about US in particular, but because of the way politics can get involved in economic power as well, and that may be increasing the vulnerability when there's a less predictable political environment going on. And so then it makes me also think about competition regulation. Like you said, this is an issue that started off with cloud computing. There are other services that these big tech companies provide. And also, if there are any UK developed industries, as soon as they get to the point where lots of financial services firms might want to adopt them, they tend to be bought by one of the big US tech companies as well. Is competition regulation a factor here for the UK to be able to build some of its own resilience to this?
So, I mean, Jessica or David may want to come in, given the Financial Conduct Authority has competition responsibilities. I think from the bank's perspective, clearly seeing a diversity of providers, provided they can offer effective and kind of resilient services, is a good thing. These markets are also prone to network effects, winner takes all type of dynamics, so they are always going to be concentrated markets. That's why we've had the critical third parties regime, and that's why it was so important to us. And clearly there is a very important role for collaboration with other types of regulators, including the competition authorities. These services, cloud, data, artificial intelligence, they're not developed exclusively for financial services. And that's why things like the Digital Regulation Cooperation Forum, which the FCA chairs, is so important. So I think it's about those collaborations as well, because these third parties are not exclusively providing services to financial institutions.
Tom put it very eloquently, but I would add that in addition to those points, there has been a lot of focus about UK sovereign AI as well, and I have participated in discussions at Number 10 and with NVIDIA in particular about how we go about creating a sovereign UK-based AI sandbox, which would help not just financial services but all sectors of the economy and give us the ability to control more of our own destiny in terms of the entire tech stack. As Tom was saying, it's not just about the software. I mean, AI is essentially a software package, but there is cloud, there's network, there's infrastructure, there's telecom, there's energy. There are many considerations in owning our destiny for technology.
So, did you want to come in?
Yeah,
can I just on that specific point?
Yeah, of course. Yeah.
Thanks. Can I just clarify on this? I mean, if you look at Amazon Web Services, Microsoft Azure, and Google Cloud, I think combined they have about 60 to 65% of the cloud market. Notwithstanding what you've just said, how realistic is it that we are from those market dynamics ever going to be in a position where we're going to have a meaningful homegrown alternative, given the embedded relationships as you've described in the sort of stack provision that these firms provide?
I don't know that I have an answer to that.
I think for people watching, it's like a fantasy. It's a line. It's a good line for all politicians to take. But in reality, if you're a large corporate where you've got a stack of services provided by one of those firms, and you're embedded in, and you've got a long-term contractual relationship, the notion that somehow you're going to easily move to something else that's going to have the resilience for a big firm is quite surely a big ask.
What I would say, just if I put my CIO hat on for a minute, when you're making a decision about your tech infrastructure front to back, you are thinking about resiliency. So you're thinking about, if this one goes down, which one do I have in the back that can pick up services? So you are spreading things around when you're making decisions about cloud providers or critical infrastructure pieces. And those are things that I'm sure David can talk more eloquently about in terms of the operational resiliency requirements that we put on firms. And then when you're making a procurement decision, the process itself will allow you to consider aspects of concentration risk, of the relative size of that provider and whether or not they have resiliency considerations that should come into effect. So, being a CIO requires you to think about all of those things at the same time so that the services that you provide are reliable. And that means that you have to work with more than just one. So it might be cost effective to put all your eggs in one basket, but I can tell you with experience it's better to have a diversified portfolio.
Thank you. Thank you very much. Mr. Dean?
I see Jonathan wants to come in briefly.
Yeah, do you mind? I've got just some stats and then also about operational resilience. So we ran these surveys in AI in general, as you know, 2022, 2024. So in terms of the top 3 providers, for cloud, that number is slightly reduced, but is almost 75%. So it's extremely high.
For the top 3?
For the top 3 combined.
Yeah.
For model use, that has increased, sort of almost doubled, but is now kind of 45%. And for data, it's increased marginally, let's say it's 30%. And so these 3 things are sort of super, super important for us in terms of the concentration. For us, we have this test called Cyber and Operational Risk Resilient Stress Test. And what that does is it kind of assumes that one of these goes down. And it's so how are you able to recover? And 2 aspects to that. One is your internal processes. As Jessica was saying, what do you roll over to? What is your backup? Is your backup operationally ready? Is it able to handle kind of the volumes? If it's pen and paper, you're not going to be able to do it. So there you have your second provider ready for you. And the other thing that's very important from our perspective is that those firms often take decisions based on what's privately optimal rather than what's optimal for the system as a whole. And so by doing these tests, we sort of bring them together in terms of how fast you can recover, how fast you reconnect, all of these things. So I think we're thinking about it in the right way, but obviously we're watching these numbers pretty closely, and I imagine we'll see them go up.
Yeah, I'm going to move on from my fears of sort of global cyber wars sending down our industry. But let's assume that, we're in a comfortable place with the critical third parties regime, and we want to engage with these companies on a particular regulatory need for the UK. I know, David Geale, we spoke before about Meta's responsiveness to dealing with financial crime, for instance. How much engagement have you had with some of the larger AI firms on this developing regulation? And are you expecting them to be responsive to the direction that British regulation is going in?
So I haven't been particularly close to that myself. In terms of, I do think the critical third parties regime is hugely important, coupled with the expectations we have on firms to manage their own exposures, thinking about materiality and concentration, not just size. That said, in terms of the consultations that we've done, and Tom may want to say more, or Jessica, what we have found is both UK firms and the firms who may or may not be within the critical third parties regime actually very responsive to this and wanting to lean in. I mean, if we think about the fact of the number of outages that we've seen, around 38% of those recently have been due to third parties. That doesn't do them any good any more than it does to actually the UK banks, who are perhaps on the front end, the sharp end with their customers.
But obviously you have good relationships with the firms.
Yeah.
Is the expectation then on the firms, if there are any issues with what they're using, to run that up the chain, or would you have direct engagement with some of these large AI companies saying, this is a big problem for British regulation, can you fix this issue?
So it depends where. Sorry, I was just saying, in terms of the critical third parties regime versus AI, so we don't know quite who's in that yet. Let's just be clear on that one. That does give us the ability to go in with those firms who may not be directly regulated UK firms. In terms of AI,
I was going to say, actually, from a DRCF perspective, if I put that hat on for
DRCF.
Digital Regulatory Cooperation Forum. So thinking about the Digital Markets Act, for example, and just thinking about some of my other responsibilities around looking at online harms and how they manifest in consumer scams. So one AI angle, for example, might be a consumer has been defrauded because they saw what they thought was Martin Lewis deepfaked recommending a crypto scheme. Right. So, for example, we are monitoring and looking at networks of bad actors and individuals and what they are doing online. and not myself, but my enforcement colleagues have conversations with the big tech firms in notifying them about bad actors and taking proactive interventions. And some of the tech firms are more responsive than others in responding to our actions.
Thank you very much, Rusu. Harriet Walburn.
Thank you, Chair. And we've obviously had a really fascinating afternoon, and lots of subjects have been covered, but I'm going to try and do an eclectic sort of bunch of ones that haven't been covered so far. And the first is to what extent your organisations are using AI to actually reduce the cost of regulation, so that you're reducing your own costs, your own headcount. Do you see potential for that there? I guess, Ms. Rusu.
I'd be delighted to talk about this for hours. We are looking at several internal use cases. One of the things that we have done horizontally across the organization is we've rolled out Copilot to all colleagues, and everyone is getting proactive training. All of our SLT is going away for intensive off-site training. So we are making sure that absolutely every employee within the FCA is educated on technology and AI in particular. In terms of our use cases, we've had some very promising results. So I'll list a few of them on sanctions screening, our social media that I was just mentioning a few moments ago, looking at the relationships between individuals and entities, identifying bad actors faster through network analytics and curation of intelligence. Synthetic data generation for anti-money laundering is a very prominent use case. In the Supervision Hub, we have call transcription that helps us actually curate that information as it comes in and turn it into intelligence. We've implemented again in the Supervision Hub, so in the inbound calls, and automatic voice recognition so that the person who's calling has the opportunity to be routed to the correct individual at the first opportunity without having to be possibly having multiple handoffs. And we are also using it in document review. As you can imagine, we have lots of unstructured information, documents, information that is sent for either supervisions or authorization casework. And we have seen incredibly promising results from the use cases that help us curate that information in a much faster way. And we're talking about enforcement outcomes going from months that it might take to research something to being able to identify it in hours. So we have been really proactive, and I think you would have seen the FCA being more proactive recently in many of its cases.
You've made a start, and there's more use cases to come. It sounds like, and more training. And at the bank, Mr. Mutton?
So likewise, I mean, a huge area of opportunity for us, both in terms of efficiency but also effectiveness. I mean, we deal with huge amounts of information, and actually the ability to use AI to start to look at unstructured information is really helpful, because that's a very valuable information source for supervisors, those doing market surveillance. We have an AI strategy. We've published that. We are very encouraging of our colleagues thinking about innovative ways to use artificial intelligence. We put safeguards around that in terms of ethical responsibilities, risk management, etc. We have an oversight committee that does that. One particular example that I think is interesting is the consultation paper on the digital pound. We had 50,000 responses. It would have been impossible for my team to read every one of those. So we actually thought about it really carefully, had a discussion with HM Treasury, and decided that we would use some artificial intelligence tools to help us with that process. We used natural language processing to help review those. We then had a secondary human review of a sample to make sure that we were satisfied with what had been concluded, and we used that to really help both make that review more feasible, because 50,000 is just a huge amount to review, but also we saw some positive cases around actually bringing in a level of objectivity in how we reviewed responses, because naturally human readers, particularly where they may have written the consultation themselves, will obviously see to some extent what they want to see in that. So we really saw a really positive opportunity, not just for efficiency in that process, but also effectiveness in terms of improving objectivity. And actually, analytically, it gave us some really interesting insights to how people felt about the digital pound. That was actually, we think, one of the first times that a regulator or a public body has used artificial intelligence in that sort of way. So we got some quite considerable external assurance. We've got people to review the models. We've got an external provider to review our model. We also got Casey legal opinion on that. And we think that is something we're very proud of, actually, in terms of actually using artificial intelligence in a quite innovative but also very responsible sort of way.
Thank you. Changing to a subject that Mr. Hall, the Governor, and the FBC recently made this statement about the risk of the actual valuation of the AI stocks themselves and the risk of a severe correction there. Would you say that's actually outweighs any of the other risks we've talked about today?
Yeah, I mean, I think it's interesting, we spend a lot of time talking about long-term hypothetical risks from AI use, but the imminent potential risk is from valuations in the market. Obviously, not only are equity markets pretty highly valued, but also credit spreads are extremely tight at the moment. And so there does seem to be somewhat of a disconnect between the sort of the valuations that we're seeing, the exuberance in the market, and and some of the challenges that are out there in the world, whether it's geopolitics or economics. So having said that, there is something sort of behind the rise in, for example, the AI stocks, and that is, a very significant increase in their revenues. And so if you look on a sort of forward PE basis, then that to some extent sort of explains the valuations rather than kind of an increase in this multiple. And so I guess the way we brought that together is to say that we're not trying to time the market, but valuations are very high. They're based on this continued increase in revenue that's impressive but expected to continue into the future. And therefore, what is the risk? For us, what we care about is the downside risk, and the downside risk is that those aren't met, those expectations, those high expectations aren't met. And if they aren't, then not only do you have the valuations which are based on those high expectations, but you also have incredibly high concentration within the market, both kind of within the US market, but also globally, of exposure to this, whether it's the actual kind of AI stocks or kind of energy producers for that, or the chip providers. So I think what we didn't want to say, we're not trying to time the market. We're just trying to say that there is a risk out there, and if, for example, optimism were to fade on the imminent benefits of this, then the markets are pricing in a pretty optimistic scenario.
Thank you. I mean, obviously, one of the risks we have touched on is the cyber risk and the stress tests that are run for industry participants. And clearly, one of the biggest worries here would be that bad actors get hold of some of the data, particularly now we're using so much more facial recognition and those databases and things like that. And so the risk of the bad guys getting into the system through cyber resilience, does AI, how much more does AI increase that danger? It's got to be a huge amount, hasn't it?
Yeah, so AI has the opportunity for bad actors as it does for good actors. It increases the velocity, the volume, and the sophistication of cyber attacks. We've already seen some examples of deep fakes, for example, phishing attacks, and sophisticated social engineering is still one of the most prominent ways that cyber attackers work, even the unsophisticated ones. It gives them an additional tool to work with, and that's why it's so important that firms continue to do their desktop exercises, pen testing, and invest in their cybersecurity infrastructure. What I would say is that cyber security technology has been using machine learning as a technique for a long time, and the increases that I'm seeing in cybersecurity software and the sort of patches that are released are incremental in nature, so I wouldn't say it's a massive step change in terms of the technology that I'm seeing right now in cybersecurity.
But the risk of the Bank of England, for example, being hacked and undermining our financial confidence as a country is got to be so significant, Mr. Mutton. That must be something that keeps you up at night.
Fortunately, I'm not responsible for our cybersecurity, but I'm sure that our Chief Technology Officer and our Head of Cybersecurity, it definitely will keep them up at night. Yes, it's a huge issue, and we have to make sure that we collaborate with all the parts of government who are able to help us in this to make sure that...
Is your backup plan pen and paper, like the National Cybersecurity Centre recommended this week?
I'm not the best person to talk about our backup plan. I can tell you that we take it incredibly seriously, and we know that people test us, and it's a lived experience for us to make sure that we are secure, and we work with all the agencies in government who can help us with that, and I'm sure we can provide you some further information about what we do there. But it is a huge issue, and it's also one where we work with financial institutions around this because they're also subject to similar sorts of issues. And as I said at the start of this session, I think non-financial risk, and in particular operational risk and cyber risks, are becoming every bit as important as conventional financial risks.
So that doesn't sound very reassuring.
We have the governor in front of us regularly. So
may I just ask one final question on a slightly different topic? With protectionism and nationalism, clearly having been very prominent recently, to what extent does data fall into the area where we should worry about barriers being put in place for the flow of data?
Our national data sets are really, really very important, and of course are actually quite fragmented currently. If you think about our tax data or NHS data or our financial service data, these are sitting in separate silos. There is an opportunity to actually bring together this information using API gateways, but that's not something that's currently done.
So is that something we should be worried about in the context of artificial intelligence, additionally being a structural problem for the UK?
I think it's important that the UK continue to invest in technology across all sectors. I think that is really important, and I think the opportunities, for example, in all sectors would outweigh sort of the risks of not looking at it. So I think it is really important to think about.
I'm not sure that I feel more worried or less worried than I did at the beginning of the session, but thank you,
lots of food for thought in this inquiry generally. But before we finish up, so thank you to our witnesses. Just Mr. Geale, it is, I think, the first time you're in front of us since May of this year, when the Payment Systems Regulator rather suddenly was subsumed into the FCA, I think, perhaps, or abolished as the government would announce it. How is the team settling into the new regime? Is there any change of day-to-day activity for you as a result of the move in May?
Well, so the government is currently consulting on the legislation to put that into effect. So the PSR at the moment still exists, and we still continue to run it as an independent subsidiary of the FCA.
Because you're twin-hatted, of course.
I am twin-hatting, yes.
So there is some change then in.
Yes. So I'm twin-hatting. So I sit on the FCA Exco and also as managing director of the PSR. We have an independent board for the PSR, which Jessica is also a member of. That will continue until the legislation changes because that's required under the legislation. The government's consulting currently. That closes next week. That consultation. I don't know when the legislation will come through, but I'm anticipating no earlier than the end.
As Rusu has highlighted, is quite slow.
No earlier than the end of next year is what I'm expecting. So we will continue to run the PSR as an entity until such time as that legislation changes. We're not sitting still, though. So you're right. My role is now double hatting, which brings together effectively the two payments areas of payment systems and payment firms together in one place. We are seeking to use single governance where we can, but respecting the fact we have independent boards.
So the boards still all completely exist as they did before.
The boards are still separate. What we are doing, though, is so something like open banking, we've brought the team together, sitting within the FCA. It reports to me. It's got PSR staff and FCA staff in it. We've also taken steps already where we can, to look at functions carried out within the PSR that could be carried out within the FCA. So a number of colleagues have already moved into the FCA, and then the PSR is effectively paying for services. A good example of this would be some moves we're making very shortly, where we've brought our two comms teams together, and what we will actually have is a dedicated payments comms function within the FCA. Which
same
I think
number
is really
of people.
same number of people in that instance, or there or thereabouts. There are. This wasn't necessarily about reduction in number of people. It was about actually streamlining the regulation.
I think we managed to get out of you last time that there's not going to be a reduction in number of people or change in payroll, but it wasn't the same people were going to do the same job more or less in the FCA. So headcount's the same at the moment.
So all PSR staff are FCA staff anyway, in terms of contract. What we are seeking to do is, wherever possible, move people across to do something very similar. That's not always possible. It is more complex in some areas, and the FCA runs different structures. So in some areas in the FCA, a function may be centralised. In the PSR, it may be devolved on a hub and spoke model, and that's the sort of thing we have to work through. So some people may end up doing something slightly differently, or by virtue of size, one person in the PSR may be doing 3 jobs equivalent in the FCA, just by virtue of the scale of the organisations. So that's the sort of thing we work through with individuals. There are some roles that are harder to...
Have you started that work with individuals yet, or you're waiting for the legislation?
We've absolutely started that work,
okay.
So that's where I say we've made a number of changes already, mainly in the operational functions. We're looking at how close we can get to an end state as quickly as we can, from an efficiency perspective, and actually for clarity for staff, so they know what they're going to do.
And one of the reasons ostensibly for doing this was about efficiency and about streamlining regulation, both important things.
Yes.
We had a conversation about how much money would be saved by doing this. At some point that will appear, presumably in the FCA accounts at the end of this financial year, or will it be after the legislation's introduced with it that they will see? Be able to winkle out what the savings have been.
Yeah, so I think it's probably when the legislation comes, because at the moment we still don't have final certainty on what that will look like. It's intended that the responsibilities and the work of the PSR transfer to the FCA, so we would continue to finish what we started. What we will do is bring things like our horizon scanning, our prioritisation together. And so what we should have is a single version of the truth on payments from the FCA and the PSR, single set of data that will enable us to prioritise accordingly. Firms would already see an element of rationalisation for themselves in terms of we can do more joint meetings, for example, so they would have one meeting rather than 2.
Okay, so there's some saving there in time for firms at this point.
There'll be some rationalisation for firms. We obviously look very closely at the PSR budget, and we look to spend it wisely, and we have an eye on doing things efficiently as possible.
Well, I would hope that a good civil servant would say that to this committee. Now, thank you very much. We'll obviously keep an eye on that. Can I thank our witnesses? That's Jonathan Hall and Tom Mutton from the Bank of England, and Jessica Rusu and David Geale from the Financial Conduct Authority. Very much indeed for their time. We have another session with the Minister, the Economic Secretary to the Treasury, for anyone excited about this, on the 4th of November. That will conclude our evidence sessions, or unless she says something that's extraordinary and we need to pursue. And then we'll be producing a report after that in due course. Thank you very much indeed.
Thank you.
Order.